How can you identify the house that you're how can you identify the house that you're buying is positive cash flow? What are the preferences?
Mm-hmm.
What is the better house, a new house or an old house, and why?
Ooh, you know what? That's a long one. That's a long one.
Okay, so basically asking how do you analyze a property, like how do you do the math to identify that it's cash flow positive?
Well, I'm gonna take out the new house or old house thing because that's not relevant. The age of the house is not relevant to the cash flow. I'm going to give you a simple answer, Rose, and then I'm going to highly recommend that you take a course. And I'm just thinking about this right now that we got super swamped. Everybody got super swamped last week when we were getting ready for the joint ventures workshop. I told everybody to reach out if they wanted a copy of the boot camp.
Yeah.
And I'm not 100% sure that
Everyone
those
got
got
it?
sent out.
Oh.
I'm not exactly, I haven't double checked
Okay.
to find that those got sent out. So once I'm done the show here, because someone reached out to me like a DM and I haven't read it yet, but I saw something like, hey, I never got that boot camp. So I'm not sure those got sent out. So I'm going to look into that today to make sure those get sent out. So now I'm wondering if Rose got the boot camp, but part of our boot camp explains how to analyze properties and how to determine cash flow and run the numbers. It really is simple. Some people like to overcomplicate the topic.
Yeah.
They want to be like, oh yeah, you need positive cash flow and it's so hard and you got to make sure that you take into account capital expenditures. And they like to throw out big words that you just never heard before. And then you got to join our $15,000, $20,000 program to find out how. No, I'm going to give you the simple answer right now, but it's going to be hard without visually showing you. So I'll give you the simple answer right now. And then if you haven't received the boot camp, we'll make sure that gets sent out today. I'll follow up with the team. And if you have any additional questions, make sure you come back tomorrow and ask again. But in order to determine if the house that you are buying is positive cash flow, what you need to do is you need to find out what the expenses on the property are first. So if you're going to be buying this property as an investment property, we already discussed earlier, you need to put a minimum of 20% down. Okay, 20% down. So if you're buying the house for $400,000 and you're putting 20% down, the mortgage is going to be $320,000. Okay, that's 80.
So that's 80%.
80% of 400,000 is 320. You're going to plug that number into a mortgage calculator with today's average interest rate, which is about
Reach out to your mortgage broker.
5.8 to 6.2, depending on your term. Okay. You're going to plug in 5.8 and you're going to amortize it over 30 years. And that's going to that'll spit out what the mortgage payment's going to be. I don't know what that number is off the top of my head. Let's say 1,900. Am I close? Now I'm curious. I like to
be right.
I like to be right. Is that a crime? You guys can wait. What did I say? 5.7, 5.8?
5.8.
I'm probably low. It's probably higher than that. 320,000. And what did I say it was going to be? 1,900?
1863. That's good.
Boom. See, side note, Rose, when you run these numbers all the time, when you've done it for so long, you can do the math in your head. And even if you can't do the math in your head, you just start to memorize different price points, different types of houses in different types of areas, different values. And you can just kind of roughly in your head, you're like, okay, a 3% mortgage on this would be this, 5% mortgage on this would be this. And it helps you just analyze properties so much faster. I don't use deal analyzers anymore. I don't use Performas. I just do it in my head. Okay. So if your mortgage payment's roughly $1,900 with a $320,000 mortgage, next you got to find out for your expenses for that property is what's the property taxes. So I'd say, let's say approximately $280 to $300 a month. Okay, I'll even add this up for you. $1,900, and then you got $300 for property taxes. Insurance, Gabby, a little over $200 a month.
Sure.
Right. Insurance for your rental property is a little over $200. You're not going to have any HOA fees or any condo fees because it's a freestanding. So your total expenses for that property are going to be $2,400 a month. Okay. And that's not taking into account property management, setting aside money for vacancy, setting aside money for repairs and maintenance, just basic expenses. Next, what you're going to do is you're going to go to RentFaster, Facebook, Kijiji, wherever, PadMapper, Zumper, wherever you look up rental properties. And I want you to type in the same property. Let's say it's a 3-bedroom single family house with a double detached garage. Okay. Type in 3-bedroom, 1,500 square foot house, double detached garage, unfinished basement into that search and see in that neighborhood or in that city, and find out how many pop up and see what the average rent is for those properties. Sorry for the noise. See what the average rent is. And I can tell you in my market, it's about $2,100. Okay. Like I said, I know my numbers. And then when people ask me, well, why don't you buy these types of houses? Because I just did it. While you, in the 2 seconds it took you to ask me that question, I already ran the numbers in my head. I know those type of houses don't cash flow, because if that house rents for $2,100 and my expenses are $2,400, my rent is not going to be able to cover my expenses. In this example, I am negative $300 a month. So what you need to get good at is get good at understanding your market, and break it down to a city and look at all the different types of properties that are available. Single family houses, duplexes, houses with secondary suites, townhouses, condo townhouses, non-condo townhouses, apartment condos. That covered all of them. I think there were 6, yeah. And then get good at knowing what the prices are in all different areas of the city, because an apartment condo in the Southeast might be a different price than an apartment condo in the Northwest. And also the rent may be different in the Southeast for the same property or same unit as it is in the Northwest. You got to get to know your city. There's only really 5 different rental types, 6 if you add in the 2 different types of townhouses, non-condo and condo. There's about 5 or 6, depending on the city. You just need to get good at all the different neighborhoods and knowing what the market rents are and what the values are for those areas. I'll give you an example. A single family house in Allard, southwest of Edmonton, or let's say Paisley. A single family house with a detached garage in Paisley, southwest Edmonton, is probably going to be somewhere in the $450,000 range. Okay. So if I do the math on that, 450,000, 80% of that is 360. Just looking for Gabby, just for confirm.
Yes.
$360,000. I'm going to punch that $360,000 mortgage in with my 5.8% interest, with my property taxes, with my insurance. I'm going to also take into account reserve fund and repairs and maintenance and everything else. And I'm going to come to the conclusion my total expenses are going to be somewhere around $2,700-ish. And my market rent for that area is about $2,200. Doesn't work. Okay. But that same single family house down in Summerside, Southeast Edmonton, might be closer to like $380, $390. And the rent, it might be $2,100, $2,200. If it doesn't work there, then I'm going to go all the way up to the Northwest and I'm going to try and find another neighborhood over there and see how much does the price of that same single family house go for and what's the market rent in that area. And as you keep searching and searching and searching and searching and getting to know your neighborhoods and your market better, what you're going to find is those unique opportunities. And a unique opportunity is where you can see that, okay, I found a neighborhood where I can buy it at a certain price, where the expenses are less than the market rent. Meaning the rent is more than the expenses, which creates that margin, which is called cash flow. Okay. So that's the easiest way to explain it. I don't understand why people have to overcomplicate this. It really comes down to just you finding those cash flowing opportunities, those unique opportunities that every market has. You got to be able to find the properties where the expenses are lower than the rent. Plain and simple. That's how you find a good cash flowing property.